Why do most hedge funds seem to make money no matter what, while retail traders, particularly new ones, struggle? Is it some secret software they have or insider info? No. The real reason is that they follow a structured, repeatable process that gives them an edge. No gambling, no guessing, just a system designed for consistent results. But here's the thing. You don't need to work for a hedge fund or have a PhD in economics or mathematics to trade like a pro. I've worked with many hedge funds, and in this video, I'm going to break down what I learned from them, the exact blueprint that they use to build their winning trading strategies. And I hope by the end of this video, you'll know how to apply these same principles to your own trading and start to make smarter moves in the market. Before we dive in, however, do me a favor, hit that subscribe button so you don't miss any future trading tips like this, and make sure that you're on top of all our videos. So now let's get started. Most retail traders jump from strategy to strategy, trying to chase the next hot setup while they figure out the holy grail. Hedge funds, on the other hand, they do the exact opposite. They design, they test, and refine their strategies with precision. So when they enter a trade, they already know the odds are stacked in their favor. The good news is that you can also do this. Hedge funds, they build strategies that actually work by following a 6-step blueprint that I'm going to share with you. Number 1, what they do is they define a strategy. Number 2, they establish money management rules. Number 3, test, test, test. Number 4, they understand performance. Number 5, they understand the drawdown of the strategy. And number 6, they're always continuously implementing improvements. I want to talk about each of these in more detail. Starting with defining a strategy. You wouldn't build a house without a blueprint, right? You have to take the same type of mentality with trading. Every hedge fund, they start by answering a few key questions to really understand and determine what type of strategy they're building before they even place a trade. Because the most important thing with trading is understanding your strategy inside and out and trying to understand all the different nuances. So the first question to ask is, will the strategy focus on fundamental analysis and macro developments like economic data, interest rates, global trends? Or is the strategy completely reliant on chart patterns, price action, and indicators like a technical trader? How does that apply to your strategy? Now, some of the best strategies combine both fundamentals for context, technicals for execution. That's what I do. But in terms of these hedge funds, they'll also ask themselves, is this strategy built for a momentum-driven trend, or does it work better in range-bound conditions? Another way to look at this is a strategy riding the trend or picking tops and bottoms? It's very, very important to understand because certain conditions are better for range-bound, certain conditions are better for trending. Some traders, they thrive on breakouts, while others make money fading the price swings. Another thing to ask yourself is, what time frame does the strategy work on? What time frame should I apply it on? And the reason for that is because the same strategy that works on a 15-minute chart with this stop and limit is not going to work on a one-day chart with the same stops and limits and parameters. You also need to think about, and they've already thought about when they design their strategies, is, are they going to hold their position for hours or days, or is it going to scalp for quick moves? Also, what markets will it trade? Just because a strategy is good for the Forex market doesn't mean the same strategy will work in crypto. So is it going to trade Forex, stocks, commodities, indices? Different markets have different liquidity, behavior, characteristics, and volatility, and you can't apply one strategy to all. You want to be a master of one versus a jack of all trades. So even if a trade is doing well, these hedge funds will always think before they place the trade about whether they want to hold the trades overnight or over the weekend. This is something that you need to consider as well. You don't want to react to your profit or loss. You want to have this decided before you even place your first trade. Another thing to consider is a strategy designed to trade the London, New York, or Asia session. The answers to these questions lay the foundation for the strategy, and the hedge funds will have answers to all of these before they even start trading. And, considering, and I really believe this, that we as individual retail traders trade our own money, our hard-earned money, instead of another person's money, like these hedge fund traders who collect a salary regardless of whether they make money or lose money. It is even more important to follow this blueprint and be as discerning and picky with the strategies that we trade, and to understand the strategies inside and out, what we'll trade, when we'll trade, how we'll trade it, before we even place the first trade. Now, money management is also very, very important. Even a profitable trading strategy will blow up your account if you don't manage the risk properly. That's why hedge funds take risk management so seriously. I mean, they have entire trading desks with risk managers, people who are with only responsibilities to make sure that they manage risk properly. And so, since this is our own money, we need to be applying the same type of seriousness to it. So how much will you risk on your account per trade? Now, most pros keep it to 1 to 2% of the capital to avoid a single loss wrecking their account. What's your risk reward? Are you aiming for 1 to 1, 2 to 1, or 3 to 1 or higher? It doesn't matter how often you win if your losses wipe out your gains, unless you have very high accuracy. How do you enter and exit trades? You need to think about this before you even put on your trade. Do you plan to scale in and scale out? Or do you want to go all in, all out? Hedge funds will oftentimes layer their trades to optimize risk reward. And when do you take profits? Do you have a fixed target, or are you going to let winners run with the trailing and a break-even stop? Make sure you think this through before you place your trade. Hedge funds never enter a trade without a clear exit plan, and they know exactly when and how they'll get out before they even get in. And that's the same approach that you should have too. Because I always say that you're the most rational before you put on a trade and the most irrational once your trade is live. This is where most traders go wrong. They see a strategy work a few times and think it's a gold mine. Hedge funds, they put their strategies through rigorous testing before risking a single dollar. This could include back testing in TradingView, MetaTrader, Easy Language, whatever is your back testing software of choice. If you don't know how to do that, just put your strategy on and scroll back to the charts and see if there's more winners than losers. If it doesn't hold up over at least 15, 20, 30 trades, depending on the time frame, it's probably not worth trading live. But backtesting alone isn't enough. A setup that looks great on a daily chart might completely fall apart on a 1 hour or 15-minute chart. So testing on multiple timeframes helps confirm consistency. And even if the backtesting looks great, you should always paper your strategies in live market conditions before committing real money. This is what hedge funds do. They always paper trade the strategy before committing serious money, because this allows them to spot execution weakness before they actually take real losses on their customers' funds. It is also important to understand performance metrics. Hedge funds, they don't just track trades, they analyze their performance with hard data. They know what their win rate is. They know how often they win versus lose. They track their expectancy, which is the average gain versus the average loss. Most importantly, they know and they calculate their profit factor, which is basically the total gross profit divided by the total gross loss. If it's above 1.5, that's great. If it's above 2, even better. If it's under 1, well, you better have a very high win ratio. There's a lot of trade journaling software these days, like TradeZella, that you can hook your account up with, and it gives you all of this information. You don't need to sit there and try to calculate it yourself in Excel. And if a strategy isn't consistently profitable, they will either tweak it or scrap it without emotional attachment. Retail traders need to think the exact same way. Managing drawdowns is also key. Even the best strategies have losing streaks. The difference that hedge funds, they plan for them. They set max drawdowns, which is a limit on how much they're willing to lose before pausing their trading. They also will analyze their worst losing streaks to try to see if there's a pattern that can be avoided in the future. A strategy that has great returns, that has deep drawdowns, on the other hand, can be both exhausting mentally and financially to trade. And so you have to really consider whether you want to trade that type of strategy. If the drawdown is too large, they may need to reduce their position sizes or tweak the strategy before it spirals out of control. Hedge funds, they always look for room for improvement. They have entire teams dedicated to this because markets change and what worked yesterday might not work tomorrow. And perhaps they can find efficiencies by analyzing their past trades. So hedge funds are always constantly adjusting the strategies to stay ahead. They track what's working and what's not and see where the deepest losses are during certain times of the day. For me, with my zip trading strategy, I realized that first of all, I make the most money in Euro crosses like Euro Aussie and Euro Kiwi and Euro CAD. I lose the most money trading the sterling pairs, which is why I took it out of my strategy. I don't trade the pound at all. And I also realized that Sunday night Mondays, usually it's flat for me. Sometimes I make money, sometimes I lose money, but the 50-50 odds isn't good enough for me. And I only realized this by following these steps I learned from the hedge funds and taking the time to review my own trading results. And that has helped me really understand my own ZIP trading strategy inside and out, so that I know when it's working, when it doesn't work, and I've taken away the underperforming periods and currency pairs in my portfolio to increase the accuracy and the hit ratio of my winners. So you need to think about, are your biggest losses happening during certain times of the day? Is it around major news releases? Many people will avoid trading during high impact news unless your strategy is designed for it, and I do the same. So many hedge funds will cut exposure before major economic releases. And that's something that I think that you should consider as well, because you never know what happens. They could also refine their trade timing. Some strategies will work better during the London session or during the New York session, during the Asia session. I know that my best trading sessions during the Asia session. I won't know this without evaluating my results. So if your results shows consistent losses certain times of the day, adjust your trading hours. Maybe tweak your exit strategies around that time. A lot of traders make the mistake of letting losing trades run while cutting winners short. Hedge funds, they do the complete opposite. They cut the losses early and let the winners ride. But you know what? For me, usually with my Asia session trades, I let those trades rise because I know that there tends to be a lot of continuation. But in my New York session trades, I usually do cut the exits early because there's less continuation. And that is also something I only learned by evaluating my results. So here's the bottom line that I have for you. If you follow this 6-step blueprint, you'll have a structured process just like the pros. No more guessing, no more gambling, just data-driven high probability trading. That's what I've learned to do. That's what I hope that you'll learn to do. And that's what explains my consistent results in ZIP. Most retail traders fail because they don't have a system. But now you know how to develop a good one. So I hope that this video has helped you. Smash that like button and drop a comment below. Which step did you not think about before watching this video? Let me know. And if you want more trading tips like this, hit the subscribe button so you never miss out. Thanks for watching, and I will see you in the next one.